Walk us through your strongest conviction in the back half of the year. We just outlined these two key risks in the market.
So I think just starting where we left off with Sean, we think things have changed materially this year and along two key dimensions. First one is what we call a big protectionism push. And to really understand that, I think we want to go along the lines of going away from the old school way of looking at trade. It's not about like tariffs, really. It's more about a broader re-questioning of global supply chain, thinking about where revenues are coming from for companies and how they're going to think about where they want to deploy their production going forward. We think that this has changed materially, and now we're in a world where this is affecting the macro outlook and the uncertainty is real. The second piece, though, big changes around central banks, and they have made a pretty significant dovish pivot. We brought a chart here on easing financial condition. I don't know if we can use it, but there's been a pretty material change since the Draghi Center speech. And that is providing to us significant support to markets. So what you see on this chart, the orange line, is our proprietary financial condition index. And you see this big turn that is happening late June, which has been offsetting a big part of the run-up we've seen from trade. So these two things are kind of doing a tug of war. As a result, we think we're in a benign environment. We heard about confirmation bias in the previous segment just before. It is the case that there's a pretty powerful force now in place with central banks that will be continue to support the markets, and that's a constructive environment for risk taking. But because of the trade tensions, we tend to be a bit more careful in where we take that risk. We still think U.S. equities are attractive for various reasons. Emerging market equities, particularly in Asia or those exposed to the trade complex, require a bit more care at this juncture.